many decades ago, when federal debt was low and most of the money creation was coming from private sector, whenever they raised interest rates, they would slow credit growth. They would slow the private sector faster than they would blow out fiscal deficits. The problem now is that now that they have over 100% of GDP, which only happened in recent years, when they raise interest rates, they ironically increase the federal deficit at a faster pace than they slow down private sector credit growth. Basically what that means is they don't have brakes anymore. The train, nothing stops this train because there's no brakes attached to it anymore. Or another way of putting it is the brakes are heavily impaired. We've kind of gone through the looking glass. We're in Wonderland now, where the rules that worked for the majority of this time frame now work backwards.
The global economy is moving through a profound structural shift, one defined by rising debt burdens, persistent inflationary pressures, and diminishing central bank control. Decades of policy choices, from chronic deficit spending to artificially suppressed interest rates, have created a system where long-term consequences are no longer a matter of theory, but a reality unfolding in real time. As this environment evolves, investors and analysts are searching for frameworks to make sense of what increasingly feels like an irreversible trajectory. One of the clearest voices capturing this dynamic is Lyn Alden, a respected macro strategist known for her data-driven analyses of monetary policy, sovereign debt, and long-term investment trends. Alden popularized the phrase, "Nothing stops this train," to describe the economic momentum now in motion, momentum fueled by structural debt, political constraints, and the need for ongoing liquidity injections. For her, this train is not a metaphor for progress, but for a runaway system driven by fiscal dominance and trapped by its own obligations. It's a signal that the mechanisms traditionally used to stabilize the economy, tightening monetary policy, reducing deficits, or cutting entitlement spending, are now largely off the table. At the heart of Alden's thesis is the recognition that central banks are no longer operating independently. The explosion of government debt, particularly following the COVID-19 crisis, means that raising interest rates to combat inflation directly increases the cost of servicing that debt. This creates a feedback loop where monetary tightening becomes politically and economically dangerous, forcing central banks to keep rates lower than inflation for extended periods. The result is financial repression, where savers are penalized and real returns are eroded. In Alden's view, this is not a temporary adjustment, but a systemic shift, one that ensures the train keeps moving, regardless of the risks ahead. Alden recently presented a detailed breakdown of this thesis at the Bitcoin 2025 conference, explaining exactly why nothing stops the fiscal dominance train and why everyone needs hard assets like Bitcoin and gold. As we bring you clips from the presentation, please take a moment to like this video, subscribe to our channel, and turn on post notifications for more insightful analysis. Thanks, and enjoy the video.
So over the past several years, I popularized the term "nothing stops this train." And of course, that originally comes from the show Breaking Bad. And for those that have not seen it, it's about a chemistry teacher who gets diagnosed with cancer and ends up going to the dark path of cooking drugs in order to pay for his own treatment and to support his family. But of course, the moral arc of the story is that he eventually cannot stop. Even when he's past his cancer, he can no longer stop doing what he's doing. And by the 5th season of the show, his colleagues are telling him, we really have to slow down, we're getting over our skis here. And he says, no, nothing stops this train. And I've been using that term to describe what's going on with US fiscal deficits. And I'll go into, during this pretty concise presentation, what that means, why it matters, and why it's so unstoppable. Because, of course, we're here at a Bitcoin conference, but there is this much larger dollar system that's happening around us and all over the place. And so the inter-exchange between what's going on in Bitcoin and what's going on in dollar land really matters for things like the exchange rate, things for the economy, investing in general. And so we'll start now. We'll go into these kind of pretty concise slides. Some of them will be simple slides. Some of them will be a little bit more complex, but I'll walk you through the parts that really matter. So this chart here shows 2 lines. One is the unemployment rate, and one is federal deficits as a percentage of GDP. And this goes back many decades. And as you can see from the slides, there's always been very good correlation between them. During recessions, unemployment goes up, the federal deficits go up, and during better times, unemployment is low and federal deficits are low. The one brief exception, if you can kind of squint and see it on the chart, is 1960s. That's when we had the Vietnam War. So there's a little bit of an exception, but other than that, these are almost the same line. But what you'll see on the right-hand side of the chart, and I circled it in green, is over the past several years, ever since around 2017, we've had a decoupling. We've had shrinking unemployment, we've had low unemployment levels, and yet the deficit has blown out to 6 or 7%. Even before and after the pandemic, this was already happening. Obviously, it went into overdrive during the pandemic, but we're kind of in this new world now. I'm not the first person to talk about the deficits, but I am trying to bring attention to what's going on now that was not going on for many decades. We're entering kind of a new era. So that's what the deficit is. But the second main question is, why does it matter? Why are we talking about it here at a Bitcoin conference? And the short reason is because it matters for asset prices, especially anything scarce. So this chart shows in the gold line is the price of gold, and the dark line, the black line, is real interest rates. And again, we've historically seen that there's been a very strong correlation between these two things. And so for those that don't know what I mean by real interest rates, this one is specifically the 10-year Treasury yield minus CPI inflation. And the reason these two charts, gold and real treasury rates, are so worth comparing is because they're the two primary reserve assets globally. They're the ones that compete with each other at that scale. And gold, of course, is pretty scarce. The supply grows by an estimated 1 to 2% per year, but you don't get paid any yield to own it. If anything, you incur an expense for storing it. Whereas treasury yields, dollars and treasuries, they grow at a much faster supply growth, but then you get paid this yield to own them. And during periods where the yield is rather high compared to measured levels of inflation, some of the investors that might otherwise buy gold get enticed to come back to the dollar and the treasury system. But then during periods of time where the yields are not high enough compared to inflation, many investors flock to gold. They basically say, if I'm not going to get paid anything on my treasuries, why would I own treasuries that are way more abundant than gold? And historically, this has been a very strong correlation. High real rates means higher gold prices. And on this chart, the real rate is inverted. So lower means higher real rates. And again, as you've seen over the past several years, this one in particular starting around 2022, we've had a complete decoupling in the price of gold and real rates. So something new is happening here in this kind of fiscally dominant environment. And of course, this is relevant for Bitcoin. A lot of people, if you would have said 5 years ago, if interest rates are 4 or 5%, would Bitcoin be selling out massive conferences in Las Vegas, and would it be worth over $100,000 per coin? Most people would say no. In fact, many critics kept saying that it's just a zero-rate phenomenon. It's some bubble that's going to go away as soon as the Fed gets any sort of hawkish in them. But what we've seen over the past several years is the Fed got about as hawkish as they could get. They even broke some banks in the process. And yet, gold and Bitcoin both soared anyway because something changed. So these charts are a little bit noisier, but I'll direct you to the parts that matter, because this is the inflection point that really shows up. So the blue line on these charts is private sector year-over-year debt growth. So that's bank loans and that's corporate bonds, that type of thing. The red line is federal debt growth. So you have private markets and public markets. The pane on the left is 1955 to 1990, and the pane on the right is 1990 to the present. So this is a 70-year history. And if you look at the left side, for the most part, the blue line, private sector debt growth, was going up at a faster rate in any given year than public sector debt growth. And there are rather few exceptions that occur around recessions, and I mark those in yellow on the charts. And those are pretty, few and far between. During recessions, the deficits would go up, bank lending would go down, and then we move past that. What you see in the chart on the right is that ever since the 2008 global financial crisis, and especially ever since in recent years, we've been in this period of time where federal debt growth is consistently going up at a faster rate than private sector debt growth. And I highlighted again in those little green boxes, if you can see them on the right, that even outside of recessions, this is still the case. So this was happening before the pandemic, And after the dust settled, after all the money printing, it's still happening now.
As Lyn Alden explains, the heart of the problem lies in how the Federal Reserve's tools have undergone a fundamental change in effectiveness. For decades, the Fed could control credit growth and inflation by simply adjusting interest rates, raising them to cool the economy, or lowering them to stimulate borrowing. That worked in an environment where most money creation came from the private sector and federal debt levels were relatively low. But we're no longer in that world. Today, with U.S. federal debt exceeding 100% of GDP, the dynamic has flipped. When the Fed raises interest rates now, it actually causes the federal deficit to grow even faster than it slows down private sector borrowing. In other words, the policy tool that once applied brakes to the economy is now making the engine run hotter. According to Alden, this is why nothing stops this train. The brakes, interest rate policy, no longer work as intended. We've entered what she calls a kind of economic wonderland, where the old rules have broken down and started working in reverse. Higher interest rates don't rein in total credit growth like they used to, and that leaves policymakers with fewer and fewer viable options to stabilize the system. It's not just that the train is moving fast, it's that the mechanisms designed to slow it down are now actively contributing to the speed. That's the essence of Alden's thesis. We're in a new era of structural imbalance, and the tools of the past can't bring this system to a stop. Let's get back to Alden's presentation.
So for the remainder of this talk, I'll just go over a few slides of why this is so unstoppable. Why can't just a couple people get together and figure this out? Why is this so entrenched? Why is it that I'm confident to say that nothing stops this fiscal train, even regardless of election outcomes? I was saying it before the election, I was saying it after the election, because it doesn't really matter, nothing stops it. And so on this chart, we have, this is a pretty simple chart. The blue line is 10-year interest rates, 10-year Treasury interest rates. And the red line, we have debt to GDP, federal debt to GDP. And back in the 1980s, you had very low debt levels and you had very high interest rates. And we've gone on this 4 to 5 year decade journey of ever higher debt levels, but it's been offset by this structurally declining interest rate. And what that means, for example, if you double your debt but you cut your interest rates in half, your interest expense is still manageable. So for this whole 40-plus year period, interest expense was actually pretty manageable. But what happened is that eventually we hit zero. Just math kind of reasserted itself. And so now we're in an environment where the first time in decades, interest rates are not going structurally down anymore, and debt levels are still very, very high. They're the highest that they've ever been since the 1940s. And so interest expense is actually becoming a very meaningful part of the federal expense for the first time ever, and there's no easy way to get that under control. If they cut interest rates super low, then everybody wants to get into scarce assets. But if they keep interest rates high, they keep blowing out the federal deficit because we're kind of, like I said, we're kind of in Wonderland now. So that's a really big component. Another really big component is Social Security. So this chart shows the Social Security Trust Fund. And as you can see, it went from zero and it rose to about $3 trillion on that chart. And the reason for this kind of change that's happened over time is because of demographics. So the baby boomer generation was an unusually large generation born from the late 1940s into the 1960s after the World War II, a very large generation. And when they entered the workforce, they were paying into Social Security. So we had this big ramp up in the amount of funds that were invested. Now, unfortunately, they didn't invest Social Security very well. They held it in U.S. Treasury bonds, basically, which are not the best long-term investment you can make. And according to the Social Security Administration's own numbers, by about 2035, they're going to deplete that trust. And what that means in practice is that they're going to spend down this $3 trillion into the economy. That's as the baby boomer generation enters their retirement years, which they're already doing and they're going to continue to do, this is going to continue to roll over. And if you notice, this kind of hit a peak in the late 2010s. So 2017, 2018, it was kind of hitting its peak and kind of starting the very early process of rolling over. And that's when deficits decoupled from unemployment. And that's when the federal debt growth started to exceed private sector credit growth. A lot of this timing happened because at around the same time, interest rates stopped going down, and the baby boomer generation that funded a lot of this on the upside is now in drawdown mode. So this is getting spent into the economy via healthcare, via travel, via housing, basically everything that people have to spend money on. And so this is a background expenditure that's going to go back into the system over the course of the next 10 years. Now, sometimes that exact depletion date will get pushed forward or pushed back by 1 year, but this is mostly actuarial math. It's kind of inevitable. And importantly, these people vote. Young people protest, but then they forget to vote. This demographic actually votes. And right now, anything that touches the expenditure of this fund is the third rail of politics. Both major parties in the US have vowed basically not to touch Social Security over this time frame. And so this is pretty much set in stone, even in a very politicalized environment. It's one of the few things the parties basically agree on. So basically, we're completely off the tracks now. And notice nothing I said is anything about Weimar, nothing's about hyperinflation. It's all about basically long-term, unceasing 7% deficit growth. We're not talking about 70% deficits of GDP. We're talking about 7%, but it's every single year like clockwork. It's the relentlessness of it that matters. And so as we go forward, this is the system that Bitcoin's going to exist in. And if you kind of summarize this whole talk, all these charts, all these points, there's two main reasons why nothing stops this train. One is math. The way that they've constructed the Ponzi system that I've talked about before, the way that it has to always continue growing to ever not start deleveraging in the crazy way that it would. So that's the system that they've built. And two, the second reason is human nature. None of us want to pay higher taxes. People that are on the receiving side of deficits never want to cut them. Virtually no politician is ever incentivized enough to actually cut deficits during their term. And basically, this represents a flexible ledger. This is the ledger that we all kind of work with in the US and globally. And because it's a flexible ledger, they can always create more units. And therefore, that's the error correction that they keep falling back on over and over again. And that's what contrasts with Bitcoin. Bitcoin is, the complete opposite of this system in many ways. It's the mirror of this system. Instead of ever-increasing units, and indeed ever-increasing units that can't even slow down, Bitcoin is absolute scarcity. And instead of opaqueness, it's transparent. And instead of the error correction being able to just print more units, the error correction that happens in Bitcoin is deleveraging can happen, but you can never go after the unit itself. So basically, nothing stops this train. For the next 10 years, we're going to be running very large fiscal deficits in the US, almost regardless of what else happens. There are certain things that can accelerate it a lot. There are certain things that can maybe decelerate it a little bit, nothing meaningfully. And so the one way to protect yourself from that situation is to own the highest quality scarce assets. And of course, the one we all like here is Bitcoin.
Nothing stops this train is both a diagnosis and a warning. It implies that the path of inflation, debt monetization, and currency debasement is no longer avoidable, but is baked into the system. Alden sees this as a call for investors to reposition themselves, away from assets that depend on low inflation and stable monetary policy, and towards stores of value like Bitcoin, gold, and productive real assets. Rather than waiting for a return to economic normalcy, Alden's message is clear. Understand the direction of this train, because trying to stop it is no longer an option. What makes Alden's perspective especially compelling is that it doesn't rely on sensationalism. There are no warnings of imminent hyperinflation or collapse. Instead, she points to something far more enduring and insidious: the relentlessness of structural deficits. We're not talking about extreme budget shortfalls, but steady, unceasing deficits of 7% of GDP year after year. That's what makes this train unstoppable. Not a single dramatic event, but a compounding system that grows larger with each fiscal cycle. The incentives are baked in. Politicians won't raise taxes or cut spending in any meaningful way, and the public isn't demanding it either. The system keeps expanding because it must, and because no one is rewarded for doing otherwise. Alden argues that this is the nature of the fiat system, a flexible ledger built on the promise of being able to always issue more units. That flexibility is the system's own form of error correction. When in doubt, print more. But Bitcoin, she explains, is fundamentally different. It is the hard mirror image of this system. Instead of opacity, it offers transparency. Instead of infinite issuance, it offers absolute scarcity. And instead of solving problems through dilution, Bitcoin enforces discipline through voluntary deleveraging without ever compromising the integrity of the underlying unit. In Alden's view, this contrast is not just philosophical, but practical. Over the next decade, Alden expects the US to run persistent and significant fiscal deficits regardless of political shifts or economic conditions. The magnitude may vary, but the direction is fixed. There may be moments of slowing, but nothing, structurally or politically, exists to meaningfully change course. That's the point of her thesis. The train doesn't stop because the brakes no longer work, and the passengers aren't willing to jump off. In this environment, the only rational move is to seek refuge in assets that cannot be inflated away. And that, ultimately, is where Alden's message lands. In a world of soft money and political inertia, owning hard, scarce assets is not just a hedge, it's a necessity. Bitcoin, in her view, isn't merely an investment. It's a form of self-defense against a system that can't and won't stop. What do you think? Are we really on an unstoppable track, or is there still a way to change course? Drop your thoughts in the comments below. If you found this breakdown valuable, make sure to hit that like button and subscribe for more deep dives into the macro trends shaping our financial future. And don't forget to share this video with anyone trying to make sense of where the economy is headed. Thanks for watching.